Let's get straight to it because it is an earnings palooza. Ford, PayPal, Las Vegas Sands, all on the move after hours, reporting moments ago. Facebook also reporting after the bell. That stock seeing a big reversal as the conference call is just getting underway. We've got full team coverage. Julia Borson standing by in Los Angeles. Fast Money friend Gene Munster is manning the red phone. We'll get to that in just a few minutes, but we get started with the big after hours mover so far, and that would be Tesla. Take a look at that. Down 11% right now. Let's get straight to Phil LeBeau in Chicago for what is moving this stock. Phil.
Melissa, it's not just that the 2Q loss was greater than expected. Tesla losing $1.12 per share. The estimate from analysts was for a loss of 40 cents a share. But keep in mind, the estimates were all over the map, a big wide range there. Revenue coming in at $6.35 billion, a little shy of expectations. It is the automotive gross margins that's going to get a lot of attention here. They came in at 18.9%. Remember, the concern was those margins were going to be squeezed as they were pushing out the Model 3. Was that push to make deliveries of more than 90,000 going to hurt margins? Coming in at 18.9% when many people were looking for them to be at least 20%. By the way, that's down not only compared to the second quarter of last year, but also compared to the first quarter of this year, where both of the quarters, their automotive gross margin topped 20%. They do reiterate their guidance of delivering between 360 and 400,000 vehicles this year. The Shanghai plant is on schedule to open up by the end of this year. Their guidance on the Model Y, that's the next vehicle in line. That is scheduled by the fall of 2020. They had record production in the second quarter. But again, guys, when you look at that automotive gross margins, that's what's going to get a lot of attention, coming in at 18.9%. Oh, by the way, free cash flow, $614 million positive free cash flow. Melissa, back to you.
Yeah, and that was compared to what was expected, which was $136 or so million. So that was much better. Also, the cash at the end of the quarter, cash and cash equivalents, $5 billion, the highest in Tesla's history.
And that cash flow, Melissa, that speaks to higher deliveries. That's what you would expect when you have those deliveries topping 90,000, coming in at what, about 95,000. They added a few more, a couple hundred more compared to what they said when they initially reported deliveries.
Right. The wrinkle tonight, Phil, is that this shareholder letter, which we all parse through as soon as it's released, this is the only thing that we have until a conference call at 6:30 p.m. Eastern time. So after we're long gone at home, then they get underway.
I know. Well, you do get Ford this. You get Ford. I suspect they wanted to make sure the automotive analysts could do Ford and then do Tesla.
Okay.
So that's why you have it in that order.
That makes sense. All right. So much for my conspiracy theory. Phil, thank you. Phil LeBeau in Chicago for us. Okay, so a lot of misses. Cash flow was better. They also say in their Outlook section, we believe our business has grown to the point of being self-funding. So is this 11% decline in the stock, in your view, is that warranted given
and I'm going to let Tim talk about the free cash flow because that was a pretty staggering number. But is this move to the downside warranted given everything that Phil just said and everything we're probably going to talk about? I think the short answer, Melissa, is yes. I mean, this stock was a $177 stock on June 3rd, ran up today to $267. So they really needed to crush in order for the move to continue, I think. So is the move warranted? Yes. If you're looking for an entry point, and mind you, I think we did a good job in June of sort of identifying a low. Carter Worth and Dan specifically, and I think we did a good job on the way up. I thought the stock would absolutely fail at 225 or so. I happen to think, though, that might be your entry point to get back in on the long side. So, yeah, I've gotten it wrong for the last couple month or so, but I do think you're going to get a shot to buy it again, and that comes in the form of a 50% retracement of the June low and the recent high.
Look, they lost $400 million in a quarter where they had record deliveries. What do you think is going to happen in the third quarter? This, to me, sets up an even worse third quarter. Remember the first quarter. So, I mean, the trend here, to me, is awful. And again, the gross margin at least begins to tell, I think, people that didn't think this is a structurally unprofitable car. And I'm talking about the Model 3. And the bad news is that the Model X and the Model S continue to see slower sales. Those are the cash cows. Those are the higher margins. We saw last delivery round that they were down roughly 30% in terms of those delivery numbers. A growth company doesn't cut CapEx. They don't take restructuring charges. I mean, to me, this is exactly the story that I've seen for a long time. Yes, I'm impressed by a free cash flow number. And I do think that the balance sheet is different than it was a quarter ago. The question always is, can this company, I don't know that they can say that they are self-funding when you're building unprofitable cars. That, to me, implies inherent cash burn.
It sounds pretty positive when you say self-funding. it makes you want to buy the stock when it says self-funding, because that's been the major problem with
Except that you see an 11%
exactly.
or 10% decline in the
so
after hours.
Alt's retracements is broken through. Alt's moving averages is broken through. The 50-day moving average right around 220. That's where you step in and buy it. Margins are terrible. Getting worse, and you have the tax credit that got cut in half July 1st and is going away completely at the end of this year. That's going to crimp margins even further.
Well, what if I told you guys that 2 weeks ago the stock was trading exactly where it is today? I mean, that's something I think we have to keep all this into some sort of perspective, right? I mean, July 10th, July 11th, it's trading at 235. So, yes, it's pulled back. Yes, it's probably pulled back for all the right reasons, given what they delivered in terms of the margins and everything else. The free cash flow, I think, is pretty interesting. I tend to be still more bullish than bearish on this stock. On June 4th is when we talked about stock was 180. They bought 10,000 of the July 250 calls. Those went into the money deep today. I took some of those off today and then rolled up to get a little bit more, Mel, because I actually expected that they might be able to squeeze out something this quarter that would be positive for the markets. They didn't, but I'm still owning. I own the 275s out in August, so I'll be waiting to see if we ever get to that level again. But I still think this is a great trading vehicle. And to your point, Guy, is it
got a 31% short interest right now, so you can have a lot more volatility. And for a person like you that plays options, it could be.
And tomorrow morning, the stock might be trading a lot
you.
different than it is tonight, depending on what all happens as we get a little further into the evening.
Yeah, I agree with that 100%. Could be. Listen, absolutely right. And in terms of the stuff that Pete said, playing through options is something you've said for quite some time. The interesting thing about this, and I don't know if people at home will agree, I think this gives some people on the bull side a lot of ammunition, and conversally, I think if you're bearish the name, it gives you a lot of ammo as well.
What is the bullish case out of this
free cash flow? I think where'd that number? I mean, I'm not an accountant,
and the production number, right? I mean, those two things, I think.
And they were profitable the third quarter and fourth quarter. They said that these quarters, they went right back to a loss in January, but they said that these quarters were going to be challenging ones. This one is definitely a surprise to the downside, but they're supposed to. They've already said that they look to be profitable next quarter. That remains the question.
They had record deliveries, though.
Right.
And again, they lost this kind of, it makes no sense to me. This is a company that has to work. And we've seen all the different ways in which they can try to get that Model 3 out there and bring forward sales.
What do you mean this is a company that has to work? In what way does it have to work? Does it have to work in that it can self-fund itself to the point so that maybe it has a shot at being profitable someday? I mean, are we looking at Amazon in the growth stages where we shouldn't care about losses necessarily? I'm just wondering.
No, the good question. It has to work means I think at some point Tesla no longer has that base of investor support. We've seen some of the biggest investors in the world leave the shareholder book of these guys. But when I say it has to work, really what I meant is the Model 3 has to work. That's the story of this company, not the Model X and the Model S. Those are great cars that are high-margin cars that did very well. The reason you own this company, or at least some, is for the Model 3. There are other investors, and we've had them on this show, that don't really even talk about deliveries, don't even care about auto. They care about some of the technology. They care about the data, and they care about the leadership that they have in driverless and what that means for this company and the value inherent.